I wanted to talk about why someone would choose to invest $1 million every single year into a life insurance policy. Now, to start, I am not talking about term insurance. I am not talking about universal life insurance. I am talking about a tax exempt whole life insurance policy. So these types of insurance are special in nature. They come with, of course, the death benefit, but they also come with an investment account called the cash value. Now, I'll talk on both of those points throughout this video. To start, the client themselves is a 60-year-old male, non-smoker, and their corporation is going to be the one paying for the insurance premiums. So the first question I always get is, how much insurance could someone get for $1 million of annual premiums? And of course, it depends on your age, it depends on your gender, and it depends on smoking status and your health status as well. But for this individual, 60-year-old male non-smoker in good health, they can get approximately $25 million worth of life insurance from day one. So let's just stop there for a moment. This individual writes a check from their corporation to pay for this life insurance premium, the first year premium. In exchange, the life insurance company guarantees they will pay the beneficiary of this policy $25 million. So this person could write a check for $1 million today and pass away tomorrow. Their beneficiary is going to get $25 million. Now, hopefully you don't plan on passing away anytime soon, but nonetheless, that contract is guaranteed from day one. Now, to look into this further, do you have to continue paying $1 million into this policy every single year? The answer is yes. This isn't a one pay style of policy. This is a policy that's going to take a series of payments over the years, really depending on the plan and the options you choose. For argument's sake, let's assume this individual has the cash flow to pay for the rest of their lives. So they're 60 years old. Let's say they live to age 90, so they put in $1 million for the next 30 years. The life insurance starts at $25 million, but every single year as they continue to deposit the $1 million into the policy, that life insurance amount is going to increase. It's going to grow year over year. If they paid $1 million for the next 30 years, that insurance could be very close to $60 million by the time this person reaches age 90. So the policy has more than doubled in value, assuming this person has paid their premiums every single year. Now, do they have to pay to age 90? No, absolutely not. This is just a choice. It's similar to talking about saving for your retirement. Yes, you could save more in a shorter time frame, or you could save less over a longer time frame, or somewhere in the middle. But sometimes saving on the shorter end or less years isn't necessarily better. If you have the means to continue saving, of course, that's probably more advisable. So this person has the means. They're going to look at most likely continuing to put money into this policy. Now, if they didn't want to do that, they could put $1 million in for probably 15 years, give or take, and then put their policy on what's called an offset mode. And that essentially means your own cash value is paying for your future premiums. Some people also might want to have a much shorter time frame than 15 years, and you could certainly do that. You would just give up some of the life insurance amount. So instead of starting with a $25 million policy with $1 million premium, maybe you start with $10 million of life insurance, but you only have to put in $1 million probably for 5 or 6 years. And then same thing, your policy can go on offset mode and essentially pay for itself, assuming there's enough in the cash value for future years. Now, I mentioned this individual's corporation is going to be paying for the policy. It could also be your holding company as well. It depends on if your corporation is a sellable type of company. If you plan on selling the company, you most likely don't want to have your policy in the opco that's going to be sold. You want to have it in a holdco you're going to keep for the rest of your life. So this individual is going to put it in a holdco. Now, tax rates on a holdco or opco are going to be much less than your personal marginal tax rate. So the question I get a lot of time is, should I pay for this personally or should I run this through my corporation? 9 times out of 10, it makes more sense to run it through a holdco or opco because of the tax rate situation. So holdcos or opcos can be taxed at above 500,000 of income, 26.5%. So that means every dollar you earn, you're keeping 73.5 cents on that dollar. Or if you're earning less than 500,000, the tax bracket's only 12.2%. So in return, you're keeping 87.8% on every dollar you earn. If you look at the personal marginal tax rate system, if you're in the highest tax bracket at 53.53%, then of course you're only keeping 47% of every dollar. So if you want to look at where your dollar is more powerful, it's going to be able to purchase you more using a corporate dollar versus a personal dollar. So hence that's a big reason why you would put your policy in the corporation. Now, a massive benefit you're going to get from having a corporately owned life insurance policy is something called the capital dividend account credit you'll receive when you pass away and the life insurance proceeds are paid into your corporation. So for this example, let's assume the individual lived to life expectancy. They're in their mid 80s, if not 90. That policy is worth, let's just say, $50 million. So $50 million will get paid tax-free to this individual's corporation, and the corporation's capital dividend account, CDA for short, will also get a credit for $50 million. Now, what that means is whatever the amount of credit you have in your CDA, you're able to remove assets tax-free from your corporation. So this individual could remove $50 million out of their corporation completely tax-free because of this credit. Now, to look at some planning opportunities, if the family or whoever needs that $50 million that was paid into the corporation from the life insurance policy out of the corporation, then they can just run it through the CDA and the full $50 million comes out tax-free, which is a fantastic option. If, however, that corporation or holdco has multiple shareholders or future shareholders, they may choose to keep the 50 or some of it in the corporation and pay salaries or income for a very, very long time, or use that to make investments inside the corporation. And they may have additional retained earnings that was already in the corporation they could pull out through the CDA account. So there's a few different ways to play for it, but from a generational wealth planning perspective and estate planning perspective, a tax minimization perspective, whatever you want to call it, having a CDA credit as a business owner, especially if you have assets in your corporation, is a massive benefit to having these life insurance policies, aside from just the death benefit payout. Now, my advice so far has been around the CDA credit, the life insurance payout, and this all has to take place after the life insured passes away. But a more common question I get is, what are the living benefits of these policies? How do I benefit while I'm alive from these life insurance policies? Because yes, I want to look forward into my estate planning and ensuring that there's no liquidity shortage in my estate, or all the taxes are accounted for and paid for. But are there any living benefits I can get from these policies? And the answer is absolutely yes. So as this individual writes a check every single year for that $1 million, number one, if they wanted to borrow back the full $1 million from their policy, their own life insurance policy, they can do that. It's called an immediate financing arrangement. So as long as you can write the check for that $1 million, you can use your own tax-exempt whole life insurance policy as collateral and borrow $1 million against it. So you have your $1 million back. Of course, you're paying interest, but you can use that $1 million as you would have in the first place, and you would just end up paying the interest cost on that. The interest could also be tax deductible depending on what you're doing with the money. So if you're investing the money, if you're buying real estate or putting it back into the business, there's a good chance that's going to become tax deductible as well. So it's a way for someone to get the large amount of life insurance they need, and at the same time getting their money back and just covering the interest, which is going to be significantly less than being kind of out of pocket $1 million. Now, the second thing is, kind of to that point, is this lost money? Is the $1 million going out the door if I don't do that borrowing strategy right away? Do I have to wait 5 or 10 years to access it? The answer is no. You do not have to wait 5 or 10 years. The money is not going out the door. In fact, whole life policies go on your balance sheet, considered as an asset. So if you ever fill out your net worth, whatever's in the cash value is going to be considered an asset, and a very strong asset at that. It's one of the few assets, if not only asset, that any third-party lender would consider loaning 100% to value. So even if you look at properties, no one's going to loan you 100% to value of your property. This is an asset that whatever is in the cash value, you'd be eligible, depending on the lender, to receive 100% loan to value, which is pretty significant. Now, the cash value is also going to grow every single year without you getting a tax bill in return. So there's no T3s, no T5s. It's going to grow free of annual accrual taxation, which essentially means this policy, you're putting in $1 million year 1, $1 million year 2, $1 million year 3. It could be growing hundreds of thousands, if not millions of dollars every single year without you being hit with a tax bill for yourself or for your corporation. So that's another very big advantage of these policies. They're very tax efficient. Now, another strong point of these policies is the fact that the cash value itself, that investment, cannot decrease in value. So whatever your cash value is after year 1 or year 2 or year 3 or all the way to year 30, there's a guaranteed portion of it that cannot decrease, and the life insurance company can also pay dividends on top of that. So once they do pay a dividend, it is immediately vested, which means they also can't take back the dividend. So it does not fluctuate like any typical stock portfolio. This is essentially like a set of stairs. Every single year, you're going to have a new step, a new value, and that's guaranteed and cannot be decreased or taken away from you. So it's a safe place to certainly store some of your money. And of course, it'll convert to a tax-free payout when you pass away. Now, you can also pay for a few years, borrow after year 5, pay for a few more. You can skip years. So if you skip a year and there's enough in the cash value to pay for that year's premium, you can do so. So it's very flexible as far as payment options. Some people might pay for 3-4 years, and in the 5th year, something comes up business-wise where they would prefer to take their $1 million and put it into a different project. Well, as long as there's enough cash value in your own policy, it can pay for that year to kind of help with cash flow. So there's flexibility amongst these policies as well. And like I said, as far as the borrowing against them, it's a very liquid style of product. So to kind of summarize, there is an individual who is 60 years old, male, non-smoker, putting in $1 million per year in exchange for a life insurance policy that is worth $25 million from day one. Now, as the individual continues to pay premiums, that $25 million is going to increase every single year, and it could literally increase to $50 or $60 million by the time this individual is 90 years old. Now, of course, does everybody have to put in $1 million into a policy? Absolutely not. Some people choose to put a lot more than that, actually, and some people choose to put a lot less. So, of course, it's to each their own, but I wanted to give you the highlights as to why someone would choose to put $1 million into a tax-exempt whole life insurance policy. Thanks for watching.